All right, members, so we're going to break down this euro Aussie dollar trade that we took yesterday. We made a really good profit. We closed the trade. I'm looking at getting back in again if this trend continues. We're seeing the euro going up in value against the Aussie dollar. Why is this happening? Okay, and why is the Great British Pound also going up in value against the Australian dollar? All right, so what we have to look at is the fundamentals driving these moves in the markets. And this euro trade that we took was because European inflation isn't coming down towards the European Central Bank's 2% target. So if I take up this spreadsheet here, I can give you an in-depth look at the European economy, right? So we can see euro area inflation, if I go to the euro tab, is currently, and we had inflation come out last week, and the inflation data showed that inflation, yes, headline inflation, which includes food and energy prices, is coming down from 8.5 to 6.9%. But again, that's very, very high above the European Central Bank's 2% target. But look at core inflation, which is the key. The markets are more paying attention to core inflation than headline inflation. So what is core inflation? It's in the prices of goods and services in the economy when you strip out food and energy prices. So why do they strip out food and energy prices to look at this number? Because you can't control energy prices. They're set on the international market. The oil price is not set by any country or any central bank. It's literally the price of oil based on the supply of oil being brought to the market by oil producing countries, and then the demand for oil by every country in the world. Okay, so when you strip out food and energy prices, you get a truer reading for the demand in spending domestically within a country or a region like the euro area. And if it's going away from the central bank's 2% target, and you can see it is, look, 5.2, 5.3, 5.6, 5.7. Okay, inflation is going in the wrong direction. When they're trying to bring inflation back lower, then this is why you're getting European Central Bank officials, okay, saying the European Central Bank has no choice but to raise interest rates further because inflation isn't going down, it's going up. Okay, now remember, interest rates are key when we're trading the currency markets. All right, look on the flip side. Australia's inflation data came out this week, and look what it shows. Australia's core inflation decelerated for the first time in 3 months, lending weight that the Reserve Bank of Australia's view that prices will remain steadily coming down and supporting the case for the central bank to pause their interest rate hikes. So you've got a contrasting situation in Europe compared to Australia. European inflation is going higher, Australian inflation is going lower. So the markets are saying, well, the Australian Central Bank can now pause raising interest rates, whilst the European Central Bank has to keep raising interest rates. All right. And this interest rate differential, meaning that the euro area is going to have rates going higher and higher and higher, means that it's more attractive for investors to sell Aussie dollars and buy euros. Because remember, I was explaining to you guys, if you're trading the euro Aussie dollar exchange rate, if I buy the euro against the Aussie dollar, I first have to own Aussie dollars and sell those Aussie dollars in exchange to buy euros. That's the only way you can trade a currency pair. You have to own the one currency first and then sell it to buy the other currency. That's how you buy the euro against the Aussie dollar. All right, and remember, if you look at the interest rate difference between Australia and Europe, so if you go to this spreadsheet along the left hand side, what we're looking at here is that the euro area's interest rate is going to go up to around 4.5%, but Australia's interest rate is going to stay at 3.5%. So Europe is going to have a premium interest rate over Australia. So what that means is, if Europe's interest rate goes to, let's say, 4.25%, which is like the level the markets are kind of betting on, right? And Australia stays at 3.5%, right? This is going to be Australia. Now look at this. If I sell my Aussie dollars, if I go and I buy the euro against the Aussie dollar, I buy Aussie dollars first. This is all automatically done on the broker when you're trading MT4 every time you place a trade, by the way. This is automatic. Let's say you buy the euro against the Aussie dollar. The broker immediately buys Aussie dollars and sell those Aussie dollars to buy euros, because that's the only way you can trade this exact exchange rate, right? So you're going to pay 3.5% on the lot size that you're trading. That's interest you're going to pay to borrow the Aussie dollar to buy the euro. Okay, so that's going to be a debit coming out your trading account over 365 days, but you're going to be receiving a credit into your trading account of the euro paying 4.25%. So you're making 0.75% profit off that trade, even if the exchange rate doesn't move. Okay, now think about it logically. Hedge funds, money managers with billions and billions of dollars. Now, when they know that they can sell the Aussie dollar to get free money into their trading account, Well, now you know why the currency pair is trending higher, because they're all chasing this free money. And then on top of you getting that paid that interest into your credit trading account free, imagine the euro goes up against the Aussie dollar by 10%. You've made 10% plus the free interest. This is what drives the currency markets. And that's why the euro is going higher, because markets are pricing in and betting. Okay, and I can show you right here that the European Central Bank, okay, the ECB, currently has rates at 3.21%. Look, they're going to raise it to 3.65% or maybe even higher. This is the market's predictions. But look at the Australian Central Bank's interest rate. They're at 3.5% and they're not going any higher. And you can see that here in that article, pausing interest rate hike. Okay, no more. All right, it's the same with the Great British Pound. Okay, the Bank of England has a big inflation problem. Okay, interest rates in the UK around 4.5%. Markets are betting they're going to go up to 4.85%. Why is that? Well, look at the inflation in the UK. It's exactly the same as Europe. It's going in the wrong direction. Okay, look at UK inflation, 10%, the highest in Europe. Core inflation 6.2%. Look, it was at 6.3. And it's not going lower for 4 months in a row. Inflation is basically staying where it is. This means the Bank of England has to raise interest rates to try to bring down inflation as well to their 2% target. And what is Australia doing? They're not going to be doing that. So now you get an idea as to what's driving up the pound against the Aussie dollar and the euro against the Aussie dollar, because the markets are betting Bank of England, Europe, the European Central Bank are raising rates, while the Australian Central Bank are not raising rates. This is the key. Okay, so what we want to see now is, again, European inflation remaining sticky, meaning the markets keep pricing in more interest rate hikes, and that's going to be the driver. Here is a spreadsheet. I can show you the history of government bonds. So this is the European 10-year government bond. This is the interest rate like in May 2011. Here's the Australian 10-year government bond in May 2011. And the difference is literally taking the euro interest rate and then minusing the Aussie interest rate from that to see who's paying a higher interest rate on a 10-year government bond. At that time in May, Australia was paying higher than Europe, okay? So what we can do here, the blue line is the difference and the orange line is the exchange rate. You can already see there's a very strong correlation between the blue line going up and down and the orange line following, because what happens is exactly what I just showed you. Whenever one country is paying a higher interest rate than another country, you know where money's going to flow. They're chasing that higher interest rate around the world, okay? So Aussie dollars are being sold into euros, or euros are being sold into Aussie dollars. And this difference, which was very positive in the Aussie dollar's favor at one point, back in 2022, was at 2.5%. Look how now it's gone from 2.5% now to 1.5%. Now there's only a 1% premium. But this rate is going to rapidly decline, and that's dragging the euro higher. That's the fundamental reason why we're buying euro Aussie dollar. It's exactly the same for the pound against the Aussie dollar. If I show you this spreadsheet where we look at the UK differential in interest rates, look, the blue line and the orange line, they move together. The blue line starts to go lower, the orange line goes lower. This is the exchange rate. The blue line goes higher, the orange line goes higher, the exchange rate follows. You see how interest rates really drive currencies? And this is really key for you to understand. So if inflation in Australia keeps coming down whilst inflation in the UK and Europe keeps going up, bingo, we got a good trade. We buy the pound against the Aussie dollar. We buy the euro against the Aussie dollar. These are why we're winning these trades. It's all fundamentally driven. Okay, we're not gambling. We're not taking technical trades with no understanding of what's going on. It's all based on macroeconomics. All right, members? So hope that makes sense. You now know what we're looking at, okay? And I'm also looking at Euro Canadian dollar, which has also been trading higher, and it's actually the exact same thing. Markets right now are betting on no more interest rate hikes by the Bank of Canada. Look, they're betting on interest rate cuts. So if interest rate cuts are coming in Canada whilst rates are going up in Europe, as I've already showed you, you know exactly what's going to happen. We're going to get some really sweet trades for the pound against the Canadian dollar or the euro against the Canadian dollar. That's the key that we're looking at, okay? We have to track the economic data before we try to jump into trades, all right, guys? So this is key. Let's just have a look at the Canadian inflation and update this spreadsheet. So you can see the last reading was on here, 5.9. Inflation's gone down to 5.2. I don't know why it's different size. 5.2, and then it's gone down to 4.3. Because see how quickly inflation in Canada is coming down? Now you can see why the Canadian dollar is getting weaker. because the Bank of Canada, which had been raising rates very aggressively, doesn't have to raise rates as aggressively. And look, 4.7, 4.3. Look, inflation is going down in Canada. Perfect setup for us. We know we can buy the euro against the Canadian dollar. We can buy the pound against the Canadian dollar, as well as the euro and against the Aussie dollar. So these are the fundamentals, guys. These are the key drivers when we're looking at currencies. We're always trying to find a differential in interest rate expectations between two countries, and then we get high quality trade ideas. All right, members, so hope that makes sense, but it's key and important to understand. Thank you for watching.